Hey, JJ here again from the Art of Value. As I said last time, I'm going to be trying to do these 3 or 4 times a week. And so today I've got some more follow-up from yesterday talking about Netflix. There's more news on Netflix. Obviously, the stock plummeted 35%. Was it 35.12%? It was 26 in the pre-market or post-market. And I went more. But first, I want to talk about inflation. I'm in New Zealand, Asia Pacific region, and there was some news. The inflation figures came out today, and I've got a bunch of some content here, and not that I haven't really looked at properly, so I'm just going to react to it. Try not to make this too long. I've been making these too long, so a bit shorter today. Let's see what Martin North from Digital Finance Analytics has to say about it. He follows the news from Australia and New Zealand.
Well, inflation has hit its highest level in New Zealand since 1990, but the 6.9% figure as at the March quarter is actually somewhat below market expectations, which were for a figure of 7.1%. The latest 6.9% figure is, though, up from 5.9% as at December 2021, and it's close to what the Reserve Bank of New Zealand was expecting. Now, of course, they had suggested that inflation would peak at around 7% in the first half of this year. Now, the key non-tradables, in other words, domestically generated inflation figure, is at around 6%, up from 5.3% in December, showing that there is a great deal to do in terms of controlling rising prices within the country. Now, of course, the Reserve Bank is targeted with keeping inflation at between 1% and 3%, and explicitly targeting 2%. And Governor Adrian Orr has conceded that the central bank is, quote, not in a great place now with inflation. The Reserve Bank of New Zealand's main weapon, of course, against inflation is the official cash rate, which was raised by 50 basis points to 1.5% last week, and you can expect much more hiking in the months ahead.
Yes, so New Zealand's put their cash rate up 0.5%, and the thing is, we're a small economy, small developed economy, but Wall Street and other countries look at what we're doing, other central banks. So the inflation it's the trend higher around the world. Here, 6.9%, and I can feel it. I can feel that. I'm building a house, which I showed you a picture of a while ago. And some materials like structural steel was more than double. So building materials is kind of at the forefront of high inflation, and it's unfortunate, but we kind of knew what we were getting into there. And anyway, so that's that. That's just a bit of inflation news. So next, let's get to Netflix. So yeah, 35.12% up, down since just overnight, and so that's of course more than 50%. What's it now? Let's check. So it's down, 67.3% about since 17th of November. Down. So I talked about some of the reasons for that, and what I saw with competition and how it relates to what's happening. But the other news is, of course, that was out today, is that Bill Ackman from Pershing Holdings, so famous investor, well-known investor, billionaire investor, in the value realm, sort of after Buffett, has small focused stocks, usually only about 7 or 8 stocks, so highly concentrated. Well, is that highly concentrated? It's not one stock, but not 3 stocks. There are some investors with about 3 stocks. Like Nick Sleep is known for that. Anyway, so this is his Twitter, at Bill Ackman, and I noticed he didn't put the letter, his shareholder letter, which he didn't post it after posting last quarter that they'd bought Netflix, a decent chunk of Netflix after the last quarter earnings, which fell, and so this time, but the internet was onto it and found it. Let's see what he says in the investor letter, that the reason for selling and the fact that they did. This is what Bill Ackman had to say in the shareholder letter.
Today, we sold our investment in Netflix, which we purchased earlier this year. The loss on our investment reduced the Pershing Square Fund's year-to-date returns by 4 percentage points. Reflecting this loss, as of today's close, the Pershing Square Funds are down approximately 2% year-to-date. While we have a high regard for Netflix's management and the remarkable company they have built, in light of the enormous operating leverage inherent in the company's business model, changes in the company's future subscriber growth can have an outsized impact on our estimate of intrinsic value. In our original analysis, we viewed this operating leverage favorably due to our long-term growth expectations for the company.
Okay, so the thesis has definitely changed the way that, as they see it, but it's only down a few. It means it's selling out quickly because the thesis that changed means it didn't take the fund down too much, even though they're concentrated.
Yesterday, in response to continued disappointing customer subscriber growth, Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers, and to incorporate advertising, an approach that management estimates would take 1 to 2 years to implement. While we believe these business model changes are sensible, it is extremely difficult to predict their impact on the company's long-term subscriber growth, future revenues, operating margins, and capital intensity.
Okay, so that's explains it pretty clearly. And they say, subscriber growth's growing. They can't see. Well, it's interesting because changing to this, if they change to this advertising and subscription-based model, it's kind of like Spotify in terms of it could be. Is it going to be freemium where they have free subscribers? They talk about cracking down on non-paying users, which means sharing passwords and so forth. But Spotify is a premium model where you just do advertising and then you kind of get drawn into being a premium subscriber, which isn't really that expensive for what you get, in my opinion. And so it'll be interesting to see if they take on more of an ad model, ad revenue and subscription. But will it help? Bill Ackman says it's basically too uncertain. We believe the business model changes are sensible. It is extremely difficult to predict their impact. So it seems like uncertainty is chasing them away.
We require a high degree of predictability in the businesses in which we invest due to the highly concentrated nature of our portfolio. While Netflix's business is fundamentally simple to understand, in light of recent events, we have lost confidence in our ability to predict the company's future prospects with a sufficient degree of certainty. Based on management's track record, we would not be surprised to see Netflix continue to be a highly successful company and an excellent investment from its current market value. That said, we believe the dispersion of outcomes has widened to a sufficiently large extent that it is challenging for the company to meet our requirements for a core holding.
Okay, so basically uncertainty, risk-reward is less asymmetric. Perhaps they see that more uncertainty about being able to predict the outcome, so they're out. What else? This is a short letter actually, so not much to go.
One of our learnings from past mistakes is to act promptly when we discover new information about an investment that is inconsistent with our original thesis. That is why we did so here. We are in the midst of an opportunity-rich environment for Pershing Square due to the dramatic shift in Federal Reserve policy, the highly inflationary environment, geopolitical uncertainty, and the resulting high degree of security price volatility. We therefore expect to find a good use for the Netflix proceeds. Please feel free to contact the Investor Relations team if you have any questions about the above. We are grateful for your support and long-term partnership.
Okay, so yeah, they're out. I think that's pretty clear. So I'm just going to finish up. I'm just trying to not make this too long. I think I want to make shortened more often. So Netflix creators after shock subscriber drop. So this is on Bloomberg video with Gerber, a Kawasaki president, Ross Gerber, talking about whose investment firm is an investor in Netflix, joins Emily Chang. So Emily Chang talking to Ross Gerber. Let's see what he has to say.
Ross, this has got to hurt.
Okay.
Well,
it hurts for sure on the short term, but if you're a long-term investor like we are, I bought a little bit myself today, to be honest.
Why? Why do you think it's overdone? Why do you see potential?
Well, what's changed is really, in my mind, two things. Number one, I don't really see the competition as really being the biggest issue from other streamers. The competition is with real life, and real life is back, and people are going out, and people are going to Vegas, and people are going to Disneyland, and the problem is they're just watching less Netflix, and when you look at how many people are getting Netflix for free and what that addressable market is, which is actually a third of their total subscribers, Netflix still has a lot of room they can grow. I think another thing a lot of people are talking.
Okay, so that's not really contradictory to what Bill Ackman was saying in terms of the future could be good, but, two different investor opinions here. Do you believe Bill Ackman or Ross Gerber here about their future? He's sticking with it. He said he bought some more. He didn't sound too certain, though, did he, really, about it? It's more certain as some other things he's been talking about, so bit of a brave face, perhaps.
Talking about is this could be a byproduct of the work from home culture. Netflix has really struggled with the work from home culture because making movies and content is a collaborative process, and it's been very difficult. And Netflix has called all their employees back into the office. That's starting, I think, this month. And I think Reed Hastings and the team there are the smartest people in Hollywood, and they're going to figure out new ways to monetize their brand. And I think we just have to change the metrics that we're valuing Netflix with towards earnings growth and away from subscriber growth. And when you look at that, Netflix is a very cheap stock.
So let's talk about the ways that they could unlock new growth. One, cracking down.
Okay, so that's interesting, talking about earnings rather than subscriber growth. Is the subscribers, is it maturing, coming to the end? When I think about it in terms of Spotify, I think Spotify's got a long way to go, especially because they have that premium model where they can bring people in who aren't subscribers and have advertising. So they're up to, I think, close to 400 million subscribers, where Netflix is a lot less, but everybody's paying, well, unless they're sharing passwords. So let's see what he says about future growth. Ackman didn't say that they wouldn't continue to grow. He just said it was too uncertain to stick with it right now. But, he's a long-term investor, so.
On password sharing, how much growth is that really going to unlock? Then, of course, there's the idea of an ad-supported model, a tiered model, gaming, or maybe it's just making better content, which of all of those options seems to be the hardest.
Well, better content is.
Okay, so this is.
It's sort of a nonsensical thing. Right now, they have the most watched shows on television currently. I think it's.
So on the screen is saying changes on the way to Netflix. Netflix to explore cheaper ad-backed subscription, has been ad-free for 10 years, rejected ad model back in July 2019. Cheaper subscription with ads, part of range of things. So I haven't listened to the earnings call. I'm just getting this secondhand, but it's interesting that it seems more closer to the Spotify model. I think Spotify actually kind of dropped overnight too, probably in kind of sympathy with it. People worry about that. Let's see. 10.86% down. A lot of companies a lot of tech stocks were down that much. It was pretty brutal overnight. So it's not surprising, to be honest, when I saw that, when it was down 10%, because people associate the two together.
It's Inventing Anna, which my wife is watching like nonstop. They have the best producers in Hollywood, and they have every great project in Hollywood. So the content isn't the issue. The issue is monetizing the content in ways that they haven't in the past. And I'm a big believer that Netflix needs to reinvent the theater experience around their shows and movies. And there's many ways they can monetize between merchandise, events, and communities they can build around their content, which they currently are not. Secondly, you've mentioned two, I think, very important areas, which is an ad-supported Netflix Lite, which they take $0 in on ad revenue. And you look at a model like YouTube and how much money they're printing on advertising. And
that's the other thing, YouTube. Yep, Spotify and YouTube. So Spotify's really sort of taking the YouTube model there, I think, where they can see. Well, the thing is, it's both. Spotify started as subscription, it's very strong in subscription, but the advertising's been ramping up, and they can see the opportunity there, especially with podcasts. And it's something that Netflix can't do. They're not having, as far as I know, aren't doing podcasts. I mean, that would be so different. They would have to do something quite different there. And I think Spotify's got that, and Apple's got that covered.
The engagement, Netflix has the same engagement level as YouTube, and if they ran ads, they would be very successful, and I would advertise on Netflix for sure, and so that's another
Okay, Ross. All right, that's enough for today, I think. So if you want to get more episodes going forward, smash like, subscribe. It's interesting, I was looking at the stats, so most of I've only just started on YouTube, hardly any subscribers or views there yet, so hoping to ramp that up over time. I started on Spotify and podcasting on the audio first, so many more on Spotify, and Apple actually is still the top. So if you're on Apple, subscribe on there, and on YouTube, but you'll see, if you use Spotify, you'll see the video. All right, see you next time. Bye-bye.